Hello and welcome to the Part 2 lecture for Chapter 10, where I'll talk more about bonds. So I want to pick up where we left off with bonds issued at face value, meaning that the interest rate that exists in the contract for the bond, that's on the face of the bond that we're going to pay, is equal to the rate that investors expect. So people are willing to pay $1,000 for our $1,000 bond. So in that case, what happens here on January 1st, 2013, we issue $100,000 worth of bonds, or we borrow that much money from investors. So cash goes up by $100,000, bonds payable goes up by $100,000. So remember, those bonds are going to pay interest every year and then pay off at maturity in its entirety. So at the end of each year, we're paying $6,000 to our bondholders for interest. That's $100,000 times 0.06, and it's for a full year, so times 12 over 12. So you get $6,000. So cash goes down by $6,000, and retained earnings goes down by $6,000 because we recognize the interest expense for paying out that $6,000. I do that every year, and then when these bonds mature at the end of 5 years, I make my last interest payment on December 31st, 2017, and then I pay back the money that I borrowed in its entirety. So cash goes down by $100,000 and bonds payable goes down by $100,000, which leaves it at zero. So now let's talk about what happens when we issue bonds at a discount. And bonds could be issued at either a discount or a premium. I mentioned that in the last lecture. And I'm going to focus our homework on discounts. So I'll do a sample problem on discounts separately from this. So when bonds are issued at less than face value, the terminology they use for that is a number like 98 or 96 or 94. It means a percentage of 100. So if bonds are issued for 95 and we issued $100,000 worth of bonds like in that last problem, then we would issue them at $95,000. That means each person, instead of paying $1,000 for the bond, is paying $950 or 95% of face value. So for that, we're going to need a new account called bond discount. And that's going to be a contra account that's going to be right next to bonds payable. So it's going to have the opposite sign of bonds payable. And we're going to amortize that discount on a straight line basis over the term of the bond so that it goes to zero. What the effect of this amortization is going to be for a bond discount is it's going to increase the interest expense above and beyond the amount that we're actually paying. And I'll show you an example in a minute. So at any given point, I can determine what the carrying value of the bond is. In the case where we have a discount, it would be the bond payable less the remaining unamortized bond discount. That would be the carrying value. So here's an example similar to the first one that we did. So Company B issues $100,000 in bonds. They're 6% 5-year bonds, and they're issued at 95. So that first line there, January 1st, 2013, we received $95,000 in cash because investors didn't feel that the 6% was an adequate interest rate based on our risk profile, so they weren't willing to pay face value for our bonds. They paid 95% of face value. So we received $95,000 in cash. Even though we were only paid that amount of money, we still owe the $100,000. Our agreement is we're borrowing $100,000, we got to repay $100,000, period, regardless of what we get. So we have a liability of $100,000. Right now I have an unbalanced entry there. So I record a bond discount, like I mentioned in the last slide, negative $5,000. Now both sides are $95,000. Now I pay $6,000 of interest. So the interest that I pay is based on the face value of the bond, which is $100,000, and the interest rate on the bond. So regardless of what I received, I'm going to pay $100,000 times 6% each year. So I pay out $6,000. I also need to amortize that bond discount. I need that to go to zero between the beginning when the bond is issued and when it matures. So that's easy. It's a $5,000 bond discount over 5 years. $1,000 a year. So I reduce that bond discount. Now that means my interest expense is going to be the amount I pay plus that bond discount. So I have $7,000 of interest expense I'm going to recognize each year for 5 years. That will eliminate my bond discount. So in effect, I'm kind of feeling the pain of not getting the full 100,000 in the form of higher interest expense above and beyond what I'm actually paying out. So I do that for 5 years. At the end of 5 years, I pay back $100,000 that I agreed to borrow. So my bonds payable goes to zero. My bond discount account, as you can see here, ends up at zero. And that's the end of the transactions for that particular bond. So in a separate video, I'll walk through exercise 10-14A that'll help you with your homework. Now, bond premium is the opposite situation. Like I mentioned in the previous lecture, it's where we issue bonds at an interest rate that's higher than what investors expect. So if that's the case, they'll pay me more than $1,000. They'll outbid each other to buy my bonds and offer more money. So in that case, we would issue them at something over 105 in this example. That means I'm going to receive more money than what I actually owe. So as you can see where I'm going with this, we'll have a separate account called bond premium. It has the same type of balance that bond payable does, and we're going to amortize that over the life of the bond. In this case, the interest expense will be reduced by this bond premium. It'll be reduced by the good news of getting more than we expected. So at any given point, the carrying value of that bond is the bond value plus the unamortized bond premium. That becomes important if we pay off the bond early. You'll see that in a minute here. So in this example that we're carrying through, Company C issues $100,000 in 6% 5-year bonds. They issue them at 105. So they receive $105,000 in cash. They owe $100,000. And so they have a $5,000 bond premium, and it has the same positive balance that bond payable does. We still pay out $6,000 because the amount we pay is going to be based on the face value of the bond and the contract rate. So we pay out $6,000. But now when I amortize that bond premium with a negative number, it's going to serve to reduce my interest expense. So each year I pay out $5,000, I reduce my bond premium by $1,000, and I record interest expense of $5,000. And then at the end of the 5 years, when it matures, I pay back the full $100,000. So that zeroes out my bond payable account and zeroes out my bond premium account over the 5-year period. So it works just like discounts, just the reverse. So the last topic I want to talk about are bond redemptions. And bond redemptions occur when we choose to pay off a bond before it matures. So some reasons we might want to do that. Maybe the company has become much stronger financially and could reissue bonds at a lower interest rate. Maybe we no longer need the money that we had once borrowed. So there could be reasons that we redeem the bonds. So if we redeem the bonds at a date earlier than the maturity date, I'm going to look at what the carrying value is relative to what we have to pay to redeem it. So in that last example, Company C, let's say they redeem the bonds at 102. So they pay $102,000 to get out of the debt. In that case, they would recognize a gain of $100,000 because at that point at the end of 2014, the carrying value of the bond, in that case the bond plus the unamortized bond premium, had a carrying value of 103. So this is kind of counterintuitive. If I pay $102,000 to get out of $103,000 in debt, then I'm better off by $1,000. That's good news. Okay. If it was the opposite, say I had to pay $106,000 to get out of $103,000 of debt, now that's bad news to the tune of $3,000. So I would have a loss of $3,000 if that were the case. So if I'm able to pay out less money than my debt to be relieved of that debt, I have a gain. If I have to pay more, then I have a loss associated with that. So that's the end. There wasn't quite as much in the last part of this chapter as there was in the first part. So that's the end of the lecture for part 2 for chapter 10. So I'll separately record a video walking through exercise 10-14. That'll be a short video that may help you with your homework that's due on Friday. So if you have any questions, as always, please shoot me an email. I've heard from a bunch of you. You're also welcome to call me on my cell phone. That's 360-556-3621. Thanks a lot. Bye-bye.